So I went back to my clients and I said, you know, we need more money, and the levered return on this fund is 22. So if you don't put up money here, it's like giving up some of your position.
Mm-hmm.
And she said, you want me to go through the whole thing?
I do. It's a great story. I love the story.
So she says to me, well, but what if there are defaults? And I said, well, you know, we've been in high yield bonds for, at that point, 30 years. And our average default rate has only been 1% a year. So if the return is 22 and you lose 1% a year to the defaults, now you make 21, you have a great outcome. She says, well, what if it's worse than that? I said, well, the universe average default rate has been 4. So 22 less 4 is still 18. She says, well, what if it's worse than that? I said, the worst 5 years in history average 7.5. 12 less 7.5, 14.5, great outcome. She says, what if it's worse than that? I said, well, the worst year in history was 13. And by the way, when you have a default, you don't lose all your money. Let's say you lose 3/4. So 22 minus 3/4 of 13 is still 12. It's a terrific outcome. And by the way, in order to make 12% a year for the next 5 years, you have to have 13% a year defaults every year, and it's only happened once in history. And she says, well, what if it's worse than that? And I said to her, do you have any equities in your portfolio? And she said, yes, we do. I said, well, you better run out and sell them. Because if the world that you're walking me toward, everything crashes, equities are valueless. So the point is, it struck me what was going on. And you read that passage. And the point is this. I think that one of the most important jobs of the investor is to not swallow whole the story you're told. Everybody tells these stories because they want to attract capital to whatever it is they're hawking that day. And as that passage said, our job is to be a skeptic. And when there's too much optimism, when somebody comes in your office and says, I've been managing money for 30 years, and I've made 10% a year, and I've never had a down month, your job is to say, that's too good to be true, Mr. Madoff. Everybody, after the fact, everybody knew that they should have said too good to be true. But of course, they applied wishful thinking.
Yeah.
But what I realized from that meeting is that when there's too much pessimism, the job of the skeptic is to say, that's too bad to be true.
Right.
The point of that meeting was there was nothing I could say which would satisfy her pessimism, and where we could reach a point where she would say, you know what, it's not going to get that bad. And if it's not going to get that bad, then today's the day to buy.
Yeah.
So that was the conclusion I reached. And if you think about it, see, most people operate under the misapprehension that changes in fundamentals cause changes in prices. But that's not true.
That's not true.
It's changes in fundamentals filtered through changes in psychology that produce changes in prices. You know, fundamentals kind of go like this. You think about the economy, a good year is up 4, a bad year is down 2. So the economy kind of goes like this. Companies are levered, so their profits kind of go like this, and stock prices go like this. Why do stock prices fluctuate so much more than fundamentals? Psychology. And you know, in one of my memos, I wrote that and we saw this in the fourth quarter of last year, that in the real world, things fluctuate between pretty good and not so hot. But in the market, people go from flawless to hopeless. Mm-hmm. And when people think that the future is hopeless, meaning that asset prices incorporate zero optimism, then clearly prices are not too high, and all the surprises are likely to be on the upside. So that's great. That was the genesis.